If you have an employee stock purchase plan, more commonly known as an ESPP, in this video we explain how it works, the benefits of the plan, and the tax consequences you should be aware of. An ESPP is an incentive offered to you as an employee, which allows you to buy shares of your company's stock at a discounted price. This discount is usually 15%, which is the maximum reduction allowed by the tax code. Here is how it works. Part of your paycheck is set aside to buy the shares. These payroll deferrals then buy shares on an after-tax basis, meaning unlike your 401k, there is no immediate tax deduction for contributing into your ESPP. Most plans provide what's called a look-back provision, where you compare the share price on two different dates and purchase using the lower of the two prices. More on this in a moment. There are three key timeframes that matter. The first is the enrollment period, which is when you must decide whether to participate. The second is the accumulation period. This is simply when your contributions are set aside paycheck by paycheck for the eventual stock purchase. Third is the purchase date, when you actually acquire the shares. Once enrolled, you can see here how an ESPP is basically a rolling succession of accumulation periods that end with purchasing shares. A typical accumulation period between purchase dates is 6 months. I mentioned the look-back provision. The share price on the date of purchase is compared to the share price from the initial offering date. Whichever price is lower between the two is then discounted by up to 15% to arrive at the price paid for each share. Let's illustrate this further. Suppose the share price on your first purchase date is $30, which is more than the $20 share price from the offering date. In this case, shares would be bought at $17 a piece, which is the $20 price discounted by 15%. If you had contributed $1,000 through paycheck deferrals, you would end up owning 58 shares. Fast forward to the next purchase date, and it looks like the share price has fallen to $12. Because that is now lower than the offering date price of $20, you would get to buy shares at a 15% discount off the $12 share price. Assuming the contribution for this period is the same, $1,000, you would end up buying 98 shares. As for taxes, you must first know whether your ESPP is a qualified or non-qualified plan. Under a qualified plan, no taxes are owed until the shares that are purchased are eventually sold. Under a non-qualified plan, a portion of taxes are owed in the year shares are bought. Since a qualified plan is more common, we will focus on that type here. The most efficient way to reduce your tax bill is to hold the shares for at least 2 years from the offering date and at least 1 year from the date shares are purchased. This is called a qualifying sale. If you sell the shares within 2 years from the offering date or within 1 year of purchase, it is a disqualifying sale. Let's explain this further. If you meet the holding requirements for a qualifying sale, you pay income taxes on the difference between the closing price on the date you bought minus the price you paid. Again, the price you pay is presumably at a 15% discount. Then, the difference between the price you sold at and the closing price on the date you bought is taxed as a long-term capital gain, which stands to be lower than your income tax rate. If you didn't meet the holding requirements and it is a disqualifying sale, there is one change. You lose the long-term capital gains tax treatment on the difference between the price you sold at and the closing price from the purchase date. So instead of paying the long-term capital gains tax rate of either 15 or 20%, that portion is taxed at your higher ordinary income tax rate. The custodian your employer uses to transact shares for the ESPP will likely provide you the option to automatically sell shares once purchased. This allows you to lock in the gain earned upon purchase. If your plan has a 15% discount, you know your initial pre-tax gain is at least 15%. We are not recommending that you auto-sell shares, but simply pointing out that it may be a feature to consider if offered within your plan. The max contribution is $25,000 per year. If you've had an ESPP for a long time, that's great, but be careful about becoming too concentrated in your company's stock. Consider diversifying by selling some shares and reinvesting into others. And lastly, remember that any capital gains that result from selling shares are not taxed in a vacuum. They are combined with any other capital gains and losses you have throughout the year to arrive at your net tax burden. For more information about ESPPs, or for other financial planning guidance, visit our website or contact us directly.